Hello and welcome to this episode of the Energy Connects podcast, where we bring you the latest analysis and insights from the world of energy. I'm your host, Chiranjib Sengupta, and today we are talking about the profound changes in global energy markets brought about by the energy transition. And for that, I'm delighted to welcome Norbert Rücker, the head of economics and next generation research at Bank Julius Baer. Norbert's analytical work focuses on the structural changes in the world energy markets as a part of Bank Julius Baer's next generation thought leadership. He is also a member of Julius Baer's Responsible Investments Committee. Now, he started his career as an equity analyst, focusing on clean energy as well as oil and gas. Norbert, many thanks for joining us from Zurich. And to start off, could you give us an overview of where the industry is today in its pursuit of the energy transition?
Oh, that's of course a very big topic, but the way we look at the energy transition is basically we see it happening in three chapters. This is really zooming out, trying to get a bit of the big picture. The first chapter basically was 10, 15 years ago when it started, and it's all about clean energy. So we saw this growth phase of clean energy into kind of a smaller market, niche market, and there was a consolidation with some of the companies disappearing, and this whole flood of panels out of China, low prices. And what we're looking at today, clean energy is an established market, it's a mature market, it's really a big business. So this is more or less for us the first chapter, first third. The second one, we believe we're in the midst of it. This is about electric mobility. So we're somehow convinced that this decade, 2020 to 2030, is the decade of electric mobility. We assume that we're going to see some very swift pickup, like S-curve dynamics in terms of uh, sales of electric vehicles globally. Basically, that toward the end of the decade, we have market shares of somewhere around 80% new cars entering the road globally. And maybe some of the patterns repeat themselves, especially a consolidation pattern. And then the third part of the energy transition is where we see different things in the making currently. So this is the niche markets, the markets under development, the technologies under development. We tend to call it the low carbon era, let's say the low carbon theme. It's about hydrogen, it's about low carbon fuels, it's about biofuels. Basically, it's about lots of these different niches that likely grow into a market, but most likely not in a market that has the same size as clean energy or electric mobility. So we are basically in the midst of it, but from our perspective, the two main stories, clean energy, electric mobility, they're in full swing.
And do you think that these are the key sectors that will also be driving the transition, let's say, in the next 10 to 20 years?
Yes, we're somewhat convinced because we're looking at very established technologies. We're looking at solutions that are competitive today. Clean energy is one of the cheapest sources of energy, of electricity in most parts of the world. And if you would do a full calculation on electric cars, it's the same there. And we still have lots of technology progress. For all the other means, we see the technologies that are there that are in development. Already mentioned electrolysis, or let's say the hydrogen technology complex. You could even look at something like carbon capture and storage, or let's say even direct air capture technologies. They are being tested, they're being evolved. There seems to be a path towards commercial use of those. We see very few wildcards, and maybe one to name would be if on the nuclear side, this very promising approach of having much smaller reactors, modular reactors. If this becomes a commercial viable product, which I think there's a great possibility that we're going to see this towards the end of the decade, this could be one of the wild cards that shuffles the outlook a bit. But besides that, it doesn't need that much more from our perspective.
Right. Now, you argued recently that Europe in 2022 coped with the energy crisis much better than many had feared. So, could you please elaborate on that? And what's your outlook for this winter?
Mhm. Yeah, this was obviously a topic that had lots of attention, especially in Europe. Um, Overall, I would say we underestimated two things. We underestimated the market dynamics, the energy market, how capable markets are in terms of absorbing such intense supply shocks and rebalancing them out, and especially of how short of a time frame this can happen. And the second thing we underestimated is the resilience of Europe. And well, the first one really has to do with liquefied natural gas, or in short, LNG. The second one is how interconnected, how integrated, how well developed European energy market is. Because we're not looking only at the natural gas market, we're also looking at the electricity market, which is very much advanced, much more advanced than any other electricity market in terms of the integration, power lines, the way prices are formed on a day-to-day business, on a daily, on an hourly business, in fact. To give you an example for that, lots of the Russian natural gas, which used to come in via Germany, was in fact rerouted further south. And what really helped restore supplies in Europe was that these pipelines, they shifted flows. So basically, suddenly the LNG terminals in Spain, in Italy, helped compensate, offset for the natural gas that previously came from the east or from the north into Europe by simply rerouting the gas flows upwards to a large extent. This is just one example of how resilient the European market has, and this really helped compensate for the shortfall. The interesting thing is, if you look at the narrative today, it's still more dominated. Oh, it was the mild winter that helped Europe. Oh, it was the energy saving measures, all the government action. There's very little talk that no, the elephant in the room is really how markets worked. Sometimes the brute forces of market dynamics, but how well developed this energy market is and how the LNG market worked, this really saved Europe. There's still some concern that, oh, next winter we might see some of the shortages. But if you look at how the market reacted, this missing energy, this missing gas molecules, which are really gone for good from Russia for Europe, they basically popped up somewhere else. It's the Chinese ramp up of domestic coal production, for example, which means less natural gas demand in China from overseas imports. It's the return, the swift return to nuclear in some Asian countries, South Korea, Japan, to name a few, which adds molecules to the system. It's the accelerated energy transition, and this is really going at an amazing speed currently, especially in China, which adds new energy in terms of electrons to the system. It's also simply what commodity markets always do. You have high prices, you have a reaction by supply. So this compensation of Russia is a lasting compensation. And that's why we see less of the supply risks for next winter for Europe. And adding the very European specific element, which was the issues or challenges France had with the maintenance of its own nuclear power plants. Large parts of these power plants, they are currently under maintenance. They are ending the maintenance this year, so it seems very unlikely that we're going to see the same degree of outages heading into next winter than we had last winter. So overall, from our perspective, the outlook for energy in Europe globally is a very benign one. We would even go as far as we see risks of going into really a buyer's market very swiftly, a period of prolonged low prices. So something, if you look back, Europe experienced around 2015.
Right, that's really interesting to hear. And talking about trends, what trends do you see in low carbon technologies going forward that can make industrial value chains more resilient?
Yeah, that's a very good aspect of the energy transition. There's various overlapping things, of course. Maybe one element to point at is the reshoring that comes with the energy transition. So basically, you're seeing that the supply chains for solar modules, for wind turbines, for electric cars, but also batteries, they are being much more, let's say, decentralized. They're moving back closer to the end markets. So this gives some sort of resilience of the supply chains in terms of logistics risk, in terms of political risk to some extent. Yes, this is helped by subsidies, the infamous Inflation Reduction Act in the United States, for example. But these trends have been there before because an example is the auto market. These supply chains have always been much more regional. And it's by nature that you then start to move certain parts that come with the energy transition with electric cars, which is basically the battery, that you start to move them also closer to the regional markets. Maybe a second element is what happens to energy supplies. With clean energy, the energy supplies become more resilient because it's a hedge, a diversification against certain weather effects. And just today, these days, we're actually witnessing one of these examples. So parts of China has a drought. Hydro production is much below where it should be, much below average seasonally, but it's more or less almost fully compensated with a pickup in solar and wind generation. Because hydro, solar, sometimes wind, they have really complementary profiles. So I would say that's another aspect where we see increased resilience. It's really the resilience in the energy system. And if you frame it overall, the energy transition has an element of decentralization, which is happening because of the technologies that you're applying, but which is also happening because it's aligned somewhat with digitalization, automation, putting much more intelligence into any kind of energy system, putting more intelligence into supply chains. So there's various aspects which, from our perspective, improve the resilience of supply chains with the energy transition.
Right. Now, many experts have pointed to the electrification, for example, of economies from renewable energy sources as a fantastic opportunity, but also a significant challenge, especially when it comes to coping with the higher electricity consumption that it will involve. So, what are your thoughts on this, Norbert?
Mm-hmm. Look, the energy transition is a substantial transition, economically, socially, on many aspects. I would say with the scope of it, it aligns with something like the Industrial Revolution in terms of how it changes the economy, how it changes structures, how it changes industries, it affects businesses. So, of course, there will be various challenges on the road to come. The point is, there's very few of these challenges that we don't see a solution. If you look at some of the leaders, let's focus on clean energy. The leaders in Europe are Spain and Denmark. They show how it's possible to integrate sustainably intermittent solar and wind resources. Even if you have seasonal demand spikes, in the case of Denmark, it's winter. In the case of Spain, it's rather summer. Then technology is a moving target. Battery storage, talking about battery storage, which is tied to the electricity grid, is quite a market with, I'd say, with the biggest growth rates currently. It's a competitive market. It's a solution that doesn't need any subsidies mostly. Today, we're talking about battery storage for hours, maybe days, 1 day, 2 days. With the progress that we envision with battery technology on the back of and slipstream of the electrification, the electric cars, it's very likely that towards the end of the decade, we're going to see storage not only for hours and days, but maybe up to weeks. So the solution is there with the intermittency. The big thing is that we are looking at technologies which are competitive, which means there is a will to invest into these. It's an investment cycle. It's not a need to invest in these. So the way we look at this cycle going forward, it's really investment driven because it makes sense. It's reasonable. It's economic. It's sustainable. It's not driven by the need from the demand side. So we're rather looking at a market that tends to see maybe periods of surplus supplies, not scarcity. And if you zoom out even a bit further, a very big aspect is that often gets forgotten a bit, is underestimated. What kind of energy are we compensating? We are compensating mostly fossil fuel use, let's say in the car, where the efficiency of a combustion engine is very poor. So roughly 20-25% of the energy in a tank actually gets the car moving. We are shifting to electric cars, where the efficiency is a multitude greater in terms of 80-90%. So there's much less energy that they need to compensate within the energy transition, which means energy use overall goes down. So these are all, I think, the aspects, perspectives to consider in the question if we going to see lasting shortages or not. We don't believe so.
Right. And you briefly touched upon EVs, and mobility is a sector that you care deeply about, as we can see with the banner behind you. Now, what, in your view, is the future of electric mobility?
As touched upon briefly before, we are somehow convinced that we're in a decade of electrification, that we're going to see kind of this S-curve dynamics of application of electric cars. And the main thinking behind is that whenever a consumer, whenever us, we are taking a decision what car we want to buy, it's really not that much the cost that is the deciding element, how expensive the car is. Because otherwise, if this would be the case on the streets, there would be all the same cars driving around, budget cars. It's much more the convenience. The convenience comes with, well, what do we need the car for? So is it a big one, a small one? Is it a spacious one? Is it a fast one? Is it a city car, a compact one? Convenience is really what matters most if consumers buy a car. And basically, for us, the key element that drives the electrification is exactly the choice, the availability of all different kinds of electric cars. This availability grows. So before 2020, there were very few models, very few automakers to choose from. Today, just 3 years later, the situation looks completely different. And going ahead, this availability, all these different kinds of models, the choice even increases further. And with it comes another aspect of convenience, which is kind of the technology progress. Since the beginning of this decade, for most automakers, it's the first time that we see cars that they sell, which are designed from the ground up on a platform that's specifically fitting the EV technology. We have these first generation platforms. They give you 400, 500 kilometers of range and decent fast charging speed. We already see the next generation of electric platforms. Some automakers already have them partially, others are venturing into that. A platform which increases the driving range towards 600 kilometers, increases the fast charging capability of adding 100-kilometer range in less than 5 minutes. This really makes this product even more convenient and convincing. So even though we're looking at a product that is expensive, that you don't buy all the time, maybe you swap your car maybe all 10, 15 years, we nevertheless think that the classical S-curve dynamics apply because it's convenience driven. So these are the reasons why we are somewhat convinced that this decade is the decade of the electrification.
Right. Now, all the trends and the technology that you described so far, that to set up the infrastructure, that comes at a cost. And do you think that the cost of the energy transition is overstated, or what kind of financing would it take to fully implement, let's say, a Paris compliant transition?
Yeah, I think that's one of the key debates that we currently have. Is the energy transition inflationary or is it disinflationary? To be honest, I think from what we observe, it's quite simple. We're looking at solar and wind, which are competitive. They're the cheapest energy source. We are looking at a product like the electric car, which already today, if someone does the full calculation, not only looking at how much it costs to fill up the tank, fill up the battery, is more competitive. So for us, and looping back to what I mentioned before, this is really something that harder tends to be disinflationary because we are replacing solutions with another solution which are at least cheaper or at least more productive. And again, zooming out a bit, like any kind of technology shifts at a substantial scale, they always enhance the productivity in the long term. And a productivity boost is inflationary. So in this debate, we are rather in the camp that's saying, but wait a second, why should this be inflationary? There are aspects, of course, that could make it inflationary, which is the political overactivism that we see. Somehow the world seems to be in a constant crisis mode. This crisis mode by politicians means that there's overactivism. We are pouring currently too much subsidies into the energy transition. And I'm not sure if everyone is aware of the counter effects this has. If you overwhelm the energy business, let's say the solar business, the wind business, with too much activity, you embed a degree of inflation because capacities are tight. You don't need to do this. You can relax, sit back, and you can achieve the same growth momentum in 5 years' time instead of 3 years' time at a cheaper price, and it doesn't really move you away from reaching any net zero goals.
That's a really interesting point, Norbert. But as we understand that, there's a constant refrain that in order to avoid the worst of the climate change, the transition has to accelerate, and we are not there yet. And that also obviously requires more investments in clean energy. So where do you see such investments coming from, and what is the appetite for such investments?
Maybe there's two aspects. I'll stick with the last one. The way we look at the market, capital is not the barrier that slows down the transition. Exactly because we're looking at competitive technologies. So the companies themselves are very much willing to invest. Even if you look at technologies which are still in the early stage, which require capital markets, especially venture capital, growth capital, there isn't a barrier there either. If it's a convincing solution, if it's a convincing management, a convincing engineer, wherever it is, we rather think that these barriers are wide open. What slows the transition is other things. It's, let's say, more system intrinsic barriers. It's that we haven't adjusted the market design. I know this sounds a bit fuzzy, but let me give you an example actually out of Switzerland to illustrate what I mean by intrinsic barriers, which are unfortunately very often overlooked. If you look at the housing market in Switzerland, it's a market for tenants. So I think 50-60% actually don't own the building apartment they're living in. Maybe it's even more. But at the same time, whoever owns the building can fully pass on any kind of energy costs. So what's the issue there? The investor who has a say if this building is any efficient doesn't get anything in terms of benefits if he makes this building energy efficient, because he can pass on all the cost to whoever is currently living in the apartment in the building. So only by making sure there is the right amount of by restoring accountability and responsibility, the energy transition in Switzerland would go much faster. You can throw as much subsidies as you want into a setup like that. It eventually doesn't make the difference. So these are the systemic barriers in it. And there's lots of those barriers all over. It's really no longer the capital.
Where do you see the such investments coming from in your experience?
For the net zero goal?
Yep.
Yeah. Look, net zero really comes from our consumption. It comes from our consumption habits. That's where the footprint is. If you look at the reaching net zero, I think it's very simple to think, well, how does your personal footprint look like? Because the citizens, your personal average footprint is what defines a country's in the end the world's footprint. And there we have mobility, we have how we live, we have the goods that we consume, we have our eating habits. If you look at the energy transition and these three chapters, we are about to solve the mobility element, the housing element, and indirectly as supply chains clean up, the goods element. So basically sticking with this principle, the energy transition have three chapters, and most of them are really in the making. We're very much on the way of reaching net zero. You can add the fourth one, the food one, which is really much less energy related. This most likely will be, let's say, the fourth wave then to reach net zero. But there it's slightly more complicated because it's less about technology. It's much more about our habits, it's about culture, it's about societies, these kind of things. So yes, over a bigger time frame, and it's still a big time frame from 2020 today to 2040, 2050, these things might change too, because there's not only one generation in between, and habits can change, cultures can change over generations. But so overall, we have solutions for that. And it's really our own habits. Some of us, let's say, have this constant consumption and they adjust their consumption according to sustainability net zero goals. For others, it's simply because the new clean product makes more sense. That's exactly what we see in the electric mobility business. It's more fun to drive such cars. They're faster, they're more quiet, they're more spacious. So that's why, because of the convincing product, they're gonna buy this most likely. And as a consequence, they're gonna reach also net zero without actually that being the main aim. So maybe I sound a bit too much of an optimist, but in the end, we'll maybe just make it.
That's that's a very like a wonderful optimistic note there. And thank you so much, Norbert, for your insights and your great analysis of everything. It was a pleasure to talk to you today.
Thanks a lot for the invite.
A big thank you to all our listeners for tuning in, and we hope you really enjoyed this episode. As always, you can find more podcasts, videos, and comprehensive coverage of the energy industry at energyconnects.com. We will be back with more guests from across the industry in the next episode of the Energy Connects podcast. Until then, goodbye